Well, I think we're ready. Hopefully you guys can all hear me. My name is Steve Galster, and it's an honor and privilege to start our webinar off today with a great guy, Mike DelPrete, who I will introduce in just a minute. This webinar is put on by California Real Estate Brokers, Inc., CREB. It is a California Mutual Benefit Corporation. It is a nonprofit organization owned by its members. The members of CREB are the MLS real estate broker participants of the Metrolist Multiple Listing Service. All brokers who are participants are automatically members of CREB. Our mission is to provide our members with broker-specific educational opportunities, access to cooperative resources, and collective broker voice in the multiple listing service. A couple real quick things before I introduce Mike. We do have a Q&A at the bottom. There is no chat today. I promise at the end of this, Mike and I will get through your questions. We're really excited to get to those questions but more importantly, get to Mike. But if you don't know who Mike is, you are going to really enjoy this guy. He is he's an author. He has a book out in Adventures in Real Estate. But Mike is a global real estate tech strategist, a scholar in residence at the University of Colorado Boulder. He's a former tech entrepreneur, CEO, strategy director, and head of corporate development with broad expertise in online real estate technology. And he has a passion for growing new businesses. Get this, by age 30, Mike had bootstrapped. What that means is started from the ground up and sold his 40-person tech company, Agora Games. Do you know Agora Games? They're the people that came out with Guitar Hero and Call of Duty. That's right, this guy's a rock star. 4 years, they reached over 100 million gamers. Mike sold Agora to esports giant Major League Gaming. Mike has traveled the world talking to and working for industry-leading portals and real estate tech giants, gathering firsthand knowledge and insights on industry trends and themes. Mike, according to Tracy Fellows, the president of Global Digital Real Estate News Corporation, she said, and I quote, "I find Mike's analysis insightful and relevant. His perspectives are well-researched and considered." I am sincerely honored and pleased to turn over the program to Mike DelPrete. Mike, it's yours.
Thanks, Steve. Hey, everyone. Good morning, good afternoon. So the one thing Steve didn't mention is I'm calling in from New Zealand. A couple months ago, the family and I relocated back here. We're dual residents. We used to live in New Zealand, and that's where I am. So it's 9 a.m. here on a crisp, cloudy, rainy day. I'll save you the view, although maybe you can see it in the reflection. But anyway, yeah, good afternoon. Thanks everyone for joining. The crew asked me to come along and talk about kind of what I do best, which is an industry update. So, you know, I'm a data person. I'm a data guy. I love data. I love evidence. There's so much hype and whatnot in the real estate industry, and I like to focus in on the data and actually see what it shows us and see what it tells us. I've been really particularly interested in new models that are changing the way people buy and sell real estate, or trying to change the way people buy and sell real estate. So iBuyers, big portals like Zillow, anyone in that space, and that's what I've been tracking. So what I thought I'd do today is give a bit of an industry update. I'm going to share my screen here, and a recording's available. So if I'm going too quick or you miss something, ask a question, or also feel comforted that you know, this will be a recording will be sent out later, so you can watch it with your team, whatever you want to do. All right, so industry update. If I think about what's been going on for the past couple months, it's broken down into two areas. Kind of the two topics I'll talk about today. The first is just the market. What's going on with the market? And you probably heard a lot about this, so I'm not gonna dwell on it. I'll do a relatively brief summary of that. But second, I want to spend more time talking about the disruptors in the space. What's going on with them? What the themes are going forward, and then use that to get into a bit of a discussion. So if you have some questions, you know, put those in the queue, and we'll definitely get to them at the end. All right, so first off, market dynamics, right? Coronavirus and the lockdowns and everything that's going on. Simply put, I mean, when I look at the data, it really kind of boiled down into a supply and demand question. And this is something I've been talking about for months now, since it started. And I can illustrate this really quick with 3 key charts. So first off, supply. This is new listings coming to market. So this blue line is new listings, per week last year. And then the gray line is this year. Well, what happened? When back in March and April and May, when the lockdown started, the number of new listings coming to market took a huge hit, right? Cut down by, 30, 40, 50%. This is nationally in the US. It varies by market, but in general, quite a big hit. And then a slow recovery, basically up to parity, kind of where we were last year. Again, at a national level. So the supply, you see this big dip and coming back here. The supply, the new listings coming to market has dropped down. Next chart, demand. So demand is, pending, the best way to look at that, I think the highest accuracy is pending sales. There's a lot of people out there getting pre-approved for mortgage and this, that, and the other thing. But how many people are actually, buying houses? So the pending sales, same thing. You see the dip around the same period of time, down anywhere 30, 40%. But then back up and actually exceeding where we were last year. So that's a rebound, right? It's not just getting back up to parity, it's exceeding it. So this is just in a chart, this is illustrating what probably everybody knows. Demand is off the roof, right? There's really, really high demand and the supply is constrained. So what happens when you have, supply right now that's the same as it was last year and demand is up 25%? You have this, you have dropping inventory, dropping active listings. This is the amount of active listings nationally in the US last year. This is what it is this year, and it's just going down. When you have less inventory, there's more demand, houses will stay on market for less time, prices go up. So what we have right now, demand is outstripping supply. And when that happens, and this is kind of the other key ingredient here, demand is increasing faster than supply. So not only is demand outstripping it, but it's increasing in that way. Ton of people want to move. Ton of people are looking for houses. There's a lot of buyers out there. There's not enough supply. There's not enough sales, and that's it. That's where we are right now. I don't know what's going to happen going forward. Nobody knows. But a lot of the economic incentives for folks, low interest rates, kind of being the first and foremost, are just making this problem worse. Right? Low interest rates are making more people want to buy houses. It's not necessarily a seller incentive. All right, so that's kind of the market update. Again, happy to kind of come back to that and see what's happened. That's and I guess before I move on, that's what's happening in the U.S. And I look at markets all around the world. As I mentioned, I'm in New Zealand, but I've looked at markets everywhere from Sweden and Germany and the Netherlands to Canada, Brazil. All the markets are generally acting the same way. When you have a lockdown, people stop selling their houses. And then when the lockdown is lifted, people want to buy houses. They want to move. They're sick and tired of where they are. They just want to get out there. And that buyer demand is just increasing faster than the supply. And that's really true all around the world, in every country. So anyway, let's move on. Let's talk about the disruptors in this space. And when I think about disruptors, I'm thinking about companies like Zillow, Redfin, Compass, and Opendoor. iBuyers especially, that I'll be talking about today, due to some recent news in that space. So there's a couple key trends when we think about the disruptors. The first is surviving the pandemic, right? They need to kind of survive and get through the past couple months and then continue to demonstrate relevancy. So I'll talk about that. Second thing I'm going to talk about is their path to profitability. All of the disruptors, all of the companies I mentioned are unprofitable. So what does that mean and what's going to happen? Are they going to be able to turn a profit at some point? And then lastly is this trend of integration with the traditional industry. The lines between disruptor and disruptee, or disruptor and the traditional industry, are blurring. They're actually getting closer and closer together from both sides. And I think in a pretty interesting way, and one that offers opportunities for anybody in the industry. So I'll chat about that as well. So first off, if we zero in just on iBuyers to set some context, the iBuyers market share nationally from 2018 to 2019 doubled. Went from 0.25% to 0.5%. So that's national market share. Keep in mind the iBuyers were not national, so it's just, this is the data, right? In certain markets like Phoenix, market share was up to 5-6%. But again, nationally, this is where we're at. And I think, interestingly enough, it's probably going to get cut in half again, back down to 0.25% in 2020 with the coronavirus and lockdown and whatnot. So when you hear about iBuyers, just keep this in context, right? This is their national market share. It's doubling, and you should pay attention to anything that doubles. However, it's still relatively small. So you don't need to. The sky isn't falling here. There's time to react and understand what's going on. This is where they are. This is Open Door, and Zillow's basically in the same area, but you see some commonalities in terms of where these companies are. Kind of the Sun Belt, warm climates, hot, active markets, starting in Arizona, expansion into Texas and Florida and the Carolinas. Minneapolis is about as cold a market as you'll see them getting into. Denver, where I used to live, there as well. But there's also giant gaps, right? And the giant gap here is the Northeast. No iBuyer activity there yet. What's happened with the pandemic? You see in 2020, over the past 3 months, the amount of iBuyer purchases dropped 90%. So that's a big problem, right? The iBuyers all paused their purchases during lockdown because there was a lot of uncertainty, and they didn't feel it was prudent from a business standpoint, health and safety standpoint, to continue being an iBuyer in that time. So iBuyer purchase volumes dropped 90%, which is more than total purchase. I mean, that is overshooting anything else that's happening in the market. Overall consumer purchases did not drop 90%, but that really ground to a halt. So what's it going to look like for the rest of the year? I mean, if it kind of tracks, a normal-ish recovery, just kind of going back up to where we were last year, still those purchase volumes could be down 50% year on year. That's a big drop. So pandemic and the lockdowns have really affected iBuyer volumes. It hasn't affected their sales so much. So this is looking at year-on-year sales, and you can see 2020 was off to a really strong start, but it did drop, but not nearly as much. I mean, the iBuyers were still selling thousands of houses a month. So while the pandemic stopped them from buying houses, it did not stop them from selling houses, and quite significantly. And it's when they sell a house that they book the revenue. Now, the interesting thing to note here is these 3 months, April, May, June, that's when the buys dried up, right? If you go back to this chart, that's April, May, and June, that's 90% drop. It's going to take things a couple months to flow through the system. So I think you'll really see iBuyer sales start to suffer later on, kind of in the 3 months we are right now. I'm getting some data. We've got July data. August and September are still rolling in. So we'll see what that ends up looking like as we continue through the end of the month here. But I would expect this to keep dropping and frankly get worse before it gets better. Now, this is showing how those iBuyer purchase volumes are recovering in each market. And the theme here is, just really strong activity the first 3 months of the year, and then the next 3 months it just drops. And it's only starting to slowly pick up, right? In all these states, Arizona, Texas, Georgia. iBuyer purchase activity right now is just a fraction of what it was. And I think the reason for that is I think the customer proposition of an instant offer is lower now than it was, right? The customer proposition for an iBuyer is one of certainty. You're not sure how long it's going to take to sell your home or what price you're going to get. And you don't want to have open homes and all that. Just take an offer from us and we'll give you that certainty. You get your check by the end of the week. I think that proposition's frankly disappeared. Right now, the market is so hot. If you list your home, it will sell very quickly in almost every market. And you'll either get more money. I don't want to say you'll get more money than the asking price, because that's not true. But the idea is that you won't leave money on the table. And I think that's the psychological consideration. The idea, if a consumer sells to an iBuyer, they think, oh, am I leaving money on the table? You lose that fear if you bring it to market, because then you have multiple bidders and the market is determining the price of your home and not just an iBuyer. So I think, right now, if I was going to sell my home, I don't know that I would use an iBuyer. I think that proposition is much lower than it was. And if I was an agent kind of working with a home seller to tell them their options, I probably wouldn't be introducing the concept of an iBuyer. I would just want to secure that listing, get it on the market, have it sell. So the other point in terms of market recovery here that demonstrates this, the markets themselves are recovering faster than the iBuyers are. So what I mean by that is think about market share. All right, so market share in Phoenix, beginning of the year was up 4%. It's only 1.4% in July. So if you think about the Phoenix market, the number of active transactions is basically recovered. It is what it was pre-pandemic, but the iBuyer market share is still a fraction of what it was. So while the markets have recovered quite well and quite strongly in a robust way, the iBuyer transaction volumes are still quite low. And I think that just goes back to the point I was making about that consumer proposition. Next thing to talk about is the path to profitability. All these companies are unprofitable. And you may have seen the news a couple of days ago, Opendoor announced they were going to IPO. So Opendoor is doing what's called a reverse listing, a special purpose acquisition corporation. Anyway, it's a IPO that's valuing the business at about $5 billion. And through this process, they're going to be raising kind of $500 million in additional capital. But it'll be liquid. It'll be publicly listed. You could buy stock. And it's a great way. It gives them more runway. So what does this mean? You know, I'm not going to dive too much into it now, but it basically means Opendoor is not going away. They are unprofitable. Does it matter? Not so much. Investors don't really care at this point. But as a public company, it'll be around. It'll have more money. It'll have access to more money. It's not going away. If you were kind of hoping that these new disruptive models, companies like Opendoor, would just kind of disappear and go off into the night. Sorry, it's not the case. And this is giving them more ammunition to be able to keep doing what they're doing. So they're not going to kind of get quieter. If anything, they might get louder. I think that's kind of the biggest takeaway. Is it going to be a clear path to success? Unknown. Probably not. You know, there's a lot of bumps in the road, but they'll be around. Here's a number, $300 million. If I was in front of you as an audience, I would ask, who knows what this is? $300 million is approximately how much money Opendoor lost last year in 2019. So their net loss, they lost $300 million. Coincidentally, it's also just about the same amount of money that Zillow lost on their Zillow Offers business, their own iBuyer business, $300 million. So collectively, that's over $500 million lost in iBuying. So that's what you're up against. That's what I tell people. I mean, these are companies that are out there. They're out there. They're doing something. They're clearly investing. They're willing to lose hundreds of millions of dollars. Why? They're not stupid, and they're not just trying to lose money in some sort of weird game show. They're trying to achieve something, and they're trying to achieve a change in how people buy and sell real estate. So yeah, that's kind of what, and this $300 million, that's what they're willing to gamble, right? In just 1 year in losses to achieve that. Zillow's losing a lot of money. This is showing how much their Zillow Homes business, just their iBuyer business is losing. And you can see, you know, over 2019 and 2020, it's kind of gone up, and then it's gone down. You know, and I think Q2 you can attribute to the pandemic and the lockdowns, you know, just pausing their activity. But they're still, I mean, they're every month they're willing to lose 20, 30, $40 million on this business. The losses have come down. It's not gonna, you know, I wouldn't go out to say it's gonna be profitable anytime soon. It's not the case. But they did kind of turn a page there in their losses. Now, if you take the losses and divide it by the number of homes they sell, you get the net loss per home. And you can see what's happened between 2019 and the first quarter of 2020. Zillow's gone from losing $70,000 per home it buys and sells to losing just about $40,000. So if you want to, like, you know, a great analogy of the silver lining or both sides of the coin, this is it. It's like, wow, it's great. Their losses went down, but still, oh my gosh, $40,000 lost on every home. What a horrible business model that is. And it's still not even close to where Opendoor is at. Opendoor is operating much more efficiently in this space. And one of the ways they're trying to eke out more money is this. If you go to Zillow, you see this down here, right? Save 1% on this Zillow-owned home. So if you find a home you want to buy that Zillow owns and is selling, they will give you a 1% cash back if you start with them. i.e., don't come to the table with a buyer's agent already. Because the biggest cost for Zillow and the iBuyers when they're reselling home is that buyer's agent commission. And they don't want to pay that 3% out. So what they do here is they say, just come to us directly. We'll hook you up with a local agent that we've reached an agreement on, and they'll actually do it for that 2%, right? So you save 1%, we're going to give that back to you. It's kind of a big deal, right? It's kind of a big deal. Open Door is doing the same thing, right? Open Door will save you thousands of dollars, 1% savings. Save up to 1% on your new home when you buy with a partner agent. That means going to Open Door, having them refer you to an agent, and not coming to the table with your own buyer agent that you're working for. These are some of the changes, right, that are being pushed into this space. So one of the ways these companies are going to make money, or they're going to achieve profitability, is through adjacent services like mortgage and title. So in 2019, both Open Door and Zillow launched title companies, and they launched mortgage companies. And they are mixed success. Let's say mixed success. You know, if you're out there and you're in this space and you have experience with title and escrow and mortgage, you probably realize how difficult it is. You can't just kind of swoop in and make it work for you. And so the data I've seen here, it really demonstrates that. You know, I think Open Door and Zillow are struggling to realize how difficult it is and to get traction. You know, just because you have a mortgage company doesn't mean every house you sell, they're going to use your mortgage company. Title's easier in certain states. It's definitely easier, but mortgage is tough. So but this is what they're gunning for, right? They're gunning for agent commissions and trying to get people to contact them directly and not go through a buyer's agent to make money. And they're also gunning for title and mortgage in a way to make more money and turn these unprofitable businesses into something profitable. The last theme here is this integration with the traditional industry. And you know, this is my favorite graphic to show it, right? They're coming together, iBuyers, disruptors, and the traditional industry, they're coming together. And the lines between them are blurring. So what do I mean by that? So first off, Open Door launched a brokerage. They will sell your home on the open market, which, if that sounds weird and you have to like rewind and listen to it again, I don't blame you. It is a little weird because Open Door came out against listing it. You know, they came out to say, hey, listing your home on the open market is really painful, sell it to us instead. But now they will also list it. And you know, you pay just 5% in fees. So that's 1% less than a traditional 6%. So that's blurring of the lines, right? Other stuff that's happening, OfferPad, another iBuyer, they just increased their agent referral fee from 1% to 3%. So if you're an agent representing a home seller, sell your home, get them an instant offer, and you'll get a 3% referral fee, kind of just as much as you would if you listed it. So again, OfferPad's trying to get closer to the industry by encouraging agents to see them as a serious option where they'll get monetarily compensated just the same as they would if they listed it on the open market. You will have seen a partnership between Open Door and Realtor.com. So now Realtor.com, you know, the second largest portal in the US, is now giving sellers options, and it's giving them the ability to get an instant offer on their home by partnering with Open Door. So if a consumer goes to Zillow, they can get an instant offer, right, through Zillow. If they go to Realtor.com, they can get an instant offer through Open Door. But then on the flip side, what I love about the industry actually is, you know, the traditional industry is not sitting still. They're actually taking the best ideas and making them their own. So an independent brokerage in Colorado, where I used to live, 8Z, they've launched their own suite of services, right? They can list your home on the open market. They can do an instant sale as an iBuyer. They can do bridge financing, or they can help with a listing concierge. Better Homes and Gardens, Metro Brokers in Atlanta, same thing. They've kind of branded it. You know, we'll do the traditional thing, the Metro Move, right? Or we have this Instant Move product, which is an instant sale. And in that instance, they're partnering. Metro Brokers is partnering with the iBuyers. 8Z is kind of rolling their own. And this is just the start. I mean, I've seen, you know, gosh, everybody, right? Realogy has their own program. Keller Williams has their own program. I know independent brokers, Lamakia Real Estate, Matt Curtis down in Georgia, they all have, or Alabama, they all have their own iBuyer programs that they've either launched on their own, they're funding on their own, or they're partnering with other people to provide it. Like Keller Williams is partnering with partnered with OfferPad. They just severed that. But it's just getting messy, right? So this idea of instant offers is not the exclusive domain of these new billion-dollar tech startups. The industry is actually taking what works, taking these interesting ideas that consumers love, and offering them to cement their position as like the central expert advisor in this whole process. So the worlds are coming together. Next topic I want to talk about here is the battle for consumers. Kind of what's going on, what's happening now, and what's happening with this battle for consumer eyeballs. So the number of leads that get generated every year keep going up and up and up and up and up, but the number of transactions stay the same. So what's going on? If you go to realtor.com and you fill out this form here on the right, and you enter your phone number, you will get a phone call within 5 minutes, likely within 60 seconds. And if not a phone call, a text message just to confirm, right? That's realtor.com acquired a company called Opcity, and that's what they're doing. But in terms of the battle for consumer eyeballs, that's table stakes now. If somebody's online, they fill out a form, they say, hey, I'm interested in this house, I have a question, I want to go see it. They're getting a phone call back within a matter of minutes. It's not just sending an email into the ether and fingers crossed, I hope I hear back. And guess what? If you don't hear back in a couple minutes, you're going to go somewhere else, and you're gonna keep looking until you find somebody to connect to. So this is illustrative of this battle for consumer eyeballs and this move further down the funnel. So Zillow and Realtor.com have, over the past couple of years, they've shifted from just generating leads and sending those out to realtors to qualifying leads. So Realtor.com acquired Opcity, Zillow launched a Zillow Flex program and a concierge service. What that means is there's employees working for the portals that are calling the leads first. They're calling them, they're qualifying them, and then they're sending them out to the best agent who's available now. And that's kind of a big deal, right? They're getting in the mix of this whole process. And it's really this battle of concierge. So it's about everybody's trying to kind of out concierge everybody else. I want to talk to the consumer. I want to talk to the home buyer or home seller first, and I'm going to help them out with everything they need. Mortgage, title, moving services, neighborhoods, anything. I'm going to do that. And the way that's all coming together, I think it's that battle for consumers is really turning into a battle of the concierge. So again, big theme kind of going on in the industry where big companies are putting a lot of investments. Contact us first. We're going to hold your hand through the whole process. We're going to get you in our ecosystem. So when somebody says ecosystem, that's code word for this, right? We're going to get you in our ecosystem. We're going to help you out through the whole process. So wrapping some stuff up today, and then happy to have discussion, take some questions. First off, I hope it's clear, these disruptors, they're here to stay. They have a lot of money, they have deep pockets, they're going public, they're getting more money. They are here to stay. But they're rigorously adjusting their business models to stay relevant. So they're not just sitting still and doing what they did last year. There's a lot of activity. If you look at kind of the amount of change over time, I think you'd be hard pressed to find a company executing more change than these big tech disruptors like Zillow and Opendoor. Next up, competition is fierce, right? The supply and demand imbalance. There's not a lot of houses out there. There's not a lot of inventory. So everyone's competing against each other 10 times more than they were before, whether it's agent versus agent or brokerage versus iBuyer or Zillow versus Realtor.com. Competition is fierce, and it really truly is survival of the fittest. Everybody's out there and not everybody's going to survive, but the ones that will survive, I think, are the companies, the teams, the people that are willing to invest more, move faster, all in an effort to meet changing consumer demand that's happening through the pandemic, through the lockdown, and through new technological adoption. So that's your whirlwind tour through the industry, through my eyes, as I see it. Happy to kind of pause there, and if there's any questions, we can jump into that.
Well, Mike, it looks like we got a couple questions. So one of them in the last one that just popped up a second ago is, what do you think of Opendoor's merger and going public, valued at $4.8 billion?
Yeah, that's a great question. I don't know. Public markets and valuations are a dark art. So I guess you asked, I'll tell you.
Should I buy that stock?
I'm not giving any sort of investment advice. 4.8 billion is not crazy, right? I mean, WeWork at its heyday was like 40 billion, right? So it's not a crazy valuation. And when Opendoor last raised money over a year and a half ago, it was valued at $3.8 billion. So it's only gone up $1 billion. Now, it actually, I don't know, it feels reasonable, you know what I mean? But I'll give you the counter argument is, well, who are its peers? If you think about Opendoor's valuation, benchmark that against Zillow, Redfin, Remax, Realogy. And then it gets a little tougher, because Opendoor is a business that's losing $300 million. It bought and sold 20,000 houses in 2019. Those are big losses, and those are small numbers when it comes to number of houses. So that valuation is built on the promise of the future as opposed to the realities of today. And I think there's a lot of uncertainty. I wrote something down the other day. Yeah, real estate disruption is a path paved on uncertainty and massive unprofitability. So that's kind of what we're seeing right now, right? That it's a future bet, and nobody really knows, and it's super uncertain and super unprofitable.
That's definitely not my business model to have unprofitability. But so we have another question here, and it brings up Blackstone. And what's the trend of those types of investors? Do you think they'll hold on to their single family residences as rentals, or do you think they'll move some of them? With an inventory shortage that we have, do you think the guys like Blackstone will dump some of that inventory?
That's a great question. And to be clear, that's not my area of expertise. I don't spend all day, every day thinking about that. But I guess what I can say is there's a lot of money in the system. Companies like those single family rental companies seem to be doing more activity, not less activity. I see SFR activity kind of increasing, not decreasing over time. So right now, there's nothing that would lead me to believe that they think now is a great time to just dump their inventory. I think the opposite. A lot of people are thinking, we just want to acquire as much inventory as we can, and then it'll be worth something. It'll either just appreciate, or we can rent it out and make money. It's a great time to just kind of get out there and be buying up as much as they can.
So before we move on to some of the other questions of the viewers, I just have one. So the disruptors are here to stay. So I'm a real estate agent here in Sacramento. So what's your tip to the regular realtor on how to play in today's world?
It's the last couple slides of my presentation. Just think about survival of the fittest. Think about investing more and moving fast. So yeah, and this concept of out concierging someone else. That's actually a really good story for realtors, right? Because if the battle is out concierging, well, that's the job a realtor is in anyway, right? Your job is to be the expert advisor. You are the concierge. It's built on personal connection and relationship. It's not chatbots and AI and machine learning. It's you and me talking and understanding the challenges and the opportunities and where you want to go and what you want to do there. And guess what? If you need help with something, I'm going to help you no matter what. So it's a continued focus on customer service and a great experience. It's being willing to invest and move fast when it makes sense. So that doesn't mean spend all your money and buy every technology tool out there and have VR goggles and 3D tours of everything. That's not necessarily what people want. But if your consumers are looking for X, you got to give them X, and you got to do it faster than the person down the street.
Definitely agree. So we have some of the questions that I don't think we should. I just want to respond. So Chris, I see your question about RESPA. I'm not sure that's a good discussion here. I'd love to chat with you offline about that. Georgina says, how does this all translate to small brokerages? I think you just answered that. We just got to be quicker and more nimble. And then Steven says, many IPOs this year have gone up 36% in one day from initial IPO, mostly tech companies. But a previous question was, with all these players in the iBuyer, how many will survive? How much space is there for iBuyers? Do you think they can all survive, or do you think there's going to be some mergers, or do you think some are just going to have to go away? Is there room for everybody?
Yeah, no, it's a great question. I'm trying to think how best to answer it. Let's start with defining iBuyer. If iBuy, there's iBuyers and then there's iBuyers. So Opendoor is the biggest iBuyer, and that's kind of all they do. That's their big thing, right? I think, and Zillow is a big business that generates a lot of money doing advertising, and then they also do iBuyers. OfferPad is an iBuyer that's smaller than Opendoor, but that's all they do, iBuying stuff. And then Redfin kind of did it for a little while, but it was like 1/40th the size. And then there's everybody else that I'm talking about. So it's actually quite easy for someone to stay in the game and be an iBuyer and just buy a couple houses a month. You know, that's relatively easy. And you can still go out there with the proposition to say, hey, we'll make you an instant offer on your home. And that's what brokers are doing. And it's great because it's making the phone ring. They buy a couple houses and everybody else they list. So it's very easy to stay in the game there. But yeah, so it's easy for people to stay in the game. The space for big, serious iBuyers is kind of, that chapter's closed. You know, that we have what we have right now. No one else is going to come into the game in a really big, serious way. It's relatively easy for Zillow to stay in the game, you know, because they have another business. They can kind of fund it, and they can, you know, it's like being in an airplane. You have the throttle, right? They can just pull back, right? You can lift your foot off the gas and buy less homes, and then you lose less money. So it's kind of easy for them to stay in the game. Open Door was the one with a big question around it, which was basically, you know, they're burning cash, how much cash they have in the bank. IPOing gives them a lot more runway. So frankly, it's pretty easy for them to just kind of stay in the game for a couple more years. I don't think mergers make sense. Like, what are you buying? You know, you're not buying it. There's no repeat customers. There's some technology, there's people, but you know, it's not worth $5 billion to acquire that business. So yeah, I don't know that it's mergers. I think it's pivoting, if anything, you know, and you see that with Open Door launching a brokerage, OfferPad's doing the same thing, launching a brokerage. So they're just expanding their services to become a business that is feasible and sustainable.
So here in Northern California, we have this iconic appraiser. His name is Ryan Lundquist, and he just asked a question, and it just went away from me. So what do you think will happen if we have another COVID outbreak and we have another lockdown to the real estate market?
Sorry, I just want to make sure I understand it. So basically, what happens if there's another lockdown? What's the impact on the market?
Yep.
Yeah, no, that's a great question. I've been kind of looking at that data, because what happened here in New Zealand is we had a lockdown, and then everything went back to normal, and then we had another lockdown. So I could actually see exactly what happens in the market. So what the data suggests to me, that if there's another lockdown, there will be a drop in new listing volumes, right? Demand doesn't really change much at all. If it's a severe lockdown and you can't leave your home, then yeah, demand is going to change. But the biggest impact is a drop in new listing volumes. That drop is, I'm going to go ahead and say it will be less than it was before, because we've already been through this once. It's less scary. People are more used to coronavirus and wearing masks and whatever it takes. So that drop will be less severe than it was earlier in the year. And then what I'll say is the drop is exponentially related to the severity of lockdown. So again, here in New Zealand, there's 4 levels of lockdown. 1 is just a little, and 4 is extreme. So if you kind of equate that back, you know, a level 4 lockdown would be 10 times as worse as level 3, which is 10 times as worse as level 2. So there's this exponential shift there. So if there's a little bit of a lockdown, you probably won't notice that big of a drop in new listings. But if it's severe, you know, like California just shuts down and says, okay, you got to stay at home, folks. There's no working, there's no school, there's nothing. Then it will probably be worse.
So we've got a ton of great questions. I hope you'll stick around for a second. But so the Fed chairman yesterday made some comments about foreclosures. And do you think foreclosures will be on the rise in the next 12 months? I mean, clearly we have a segment of the market, the service industry, that's been impacted probably more than any other. What do you see in the foreclosure future?
Not much. And actually, with all the great questions, I'm going to tell you if I don't know anything. And I don't know anything about what's going to happen with foreclosures. Your guess is as good as mine. I'm about what's happening now and in the past and the data. I would just be speculating, and I'd rather not.
Perfect. So Donna, I can't pronounce her last name, asked a question, and I'd love to hear your thoughts. What do you think is causing such high demand? Is it the interest rates? Is it because people were locked down with their kids and they're still stuck in the house and they need a bigger house because mom and dad are working from home and the kids are there too?
Yeah. Yes, all of those. And it's a typical, I've used the analogy before. It's just pent up demand, right? It's like if you dam up a river, for a period of time. You know, what the water that flows out is much lower, and then you remove the dam, there's a surge, and then it gets back to normal levels. Guess what? The river was dammed up for 3 months, and what we're seeing is this surge. If you think back to that graph, right, the number of demand went down, and then it went up, and then it went over where we were last year. So I think what we're seeing now is just that surge from the pent-up demand, and the fact that what usually happens over 3 months is happening in a month. There's not the inventory to absorb it. So yeah, I think it's everything you mentioned. Like, yes, it's definitely people want to move and they want an office, and they're reevaluating their home living situation, and it's low interest rates. Like, it's kind of, why wouldn't you, right? If you were thinking about moving, why would you not move right now? So it's that plus this pent up demand.
So I just need to do a little housekeeping here. So some of the questions are not appropriate for us to answer on this webinar about commissions and things like that. We don't want to get into any grief here, but so I'm going to go to the next question, and I kind of ache for the new agents, right? So I have several new agents who are trying to figure this game out, and so the anonymous attendee, he's a great guy, just asked what your advice is to new agents generating leads in today's market, and does he advertise with the iBuyers or the Zillow type things, or does he explore other channels?
If I were a new agent, I would, I don't know that that's an either or. I would do both of those things. I wouldn't necessarily advertise with the iBuyers. That's not really an option, but the iBuyers have agent partnership programs. If I were a new agent today, I would explore that. And basically I would be trying to kind of fill up my toolbox with as many tools as possible. Like, there's a lot of different ways to buy and sell homes today. iBuying is one of them, kind of bridge financing where you can buy before you sell. That's another one. A lot of these companies, not all of them, a lot of the companies realize it's great to be able to work with agents, to be able to offer those. And if you kind of play ball, and you know what, playing ball could mean taking a lower commission for volume. I don't want to get in trouble talking about commissions, but that's what they do. Opendoor and Zillow, right? They're agent partners. They get less of a commission, but they get volume. If you're willing to do that, then yeah, there can be some really good programs out there. I think, yeah, that's what I'll say on that.
So Wendy asked a question about, and this is be interesting, and I don't know how you track this data, but do you have any data about repeat business after a consumer uses the iBuyer route?
No, it is a good question. And by the way, I'm looking through the questions too. These are awesome questions. I've never had anywhere close to this many questions in a webinar I've ever done.
Hey, we'll have to pay you overtime. We're glad you're here. It's hard for me to get through some of these.
No, that's fine. I mean, yeah. I'll just say this. So I've got 12 minutes. I will stick around 12 minutes. We'll do as many as we can. If not, go to my website. It's mikedp.com. I have a mailing list. It's all free. I have tons of free content. You can follow me on LinkedIn. Like, there's more data out there. But yeah, no, Steve, I don't have data on the repeat business, but I do know they don't talk about it. So it's not a thing. It's not high. These are kind of customers in and out, and that's generally it. You know, if they're able to help them buy a home, that's great, but nobody's talking about it.
So somebody asked what you know about Redfin. What can you tell us about Redfin?
They're also unprofitable. I don't know. What do you want to know about Redfin?
Well, the question, CNBC has the CEO of Redfin on now, and he's basically saying they're not doing well. They are a discount buyer, probably a discount seller. And so this person makes a comment that the traditional real estate market hates them. And my answer is, Help You Sell's been around forever, and they've never dominated a market. So, but Redfin stock seems to be doing well.
Oh yeah. So I think the reason Redfin and Zillow stock is doing so well is because there's very few, if you want to invest in a company that combines technology and real estate, there's very few stocks to do that. So I think it's less about the business fundamentals and more about this long-term bet. I believe in technology. I believe in real estate. The pandemic is changing it. How can I invest my money? Those are my options, right? So I guess the thing I'll say about Redfin is Redfin is a real estate portal and a brokerage. That's unique. that is unique in the world. And I've spent years going all over the world looking at different models. Yeah, they have a very popular website where millions of consumers go to, and then they also have a brokerage, and they have employed agents, not 1099 contractors, employed agents. And it's a really good operating model. They're able to get high gross margins. They're able to have agents that are exponentially more efficient than industry average. It's all there, but at the end of the day, it is unprofitable. So, gosh, and their market share is teeny tiny, but that just goes to talk to the fragmentation of real estate. Like a lot of people can be successful here. The market is huge.
So I know we've had a couple questions about stocks and our investing, but one of my favorite people, a gal named Paula Swain, just asked if you think investors like SoftBank will continue to invest or are they going to drop off? And by the way, I own SoftBank, so it's one of my favorites. But what do you think of SoftBank? Think they're going to quit investing in this stuff?
I don't know. It's just I don't have a strong opinion either way. I mean, I don't think they're going to disappear. I don't know why they would stop investing. Like, this is part of the game. You make really big bets, and with big bets, you get big wins and big losses. And they've had a couple of each.
Well, we've got a lot of questions we're not going to be able to get to, but I'd like to end on this last question. And Heidi, if I could pronounce your last name, I would. But how do you think the U.S. election is going to affect our market?
No, pass.
Post-election.
Pass.
Fair enough. All right. So
this is what you get with me. Like, it's very easy to turn the TV on and get a talking head who's like spouting opinions, and it's definitely going to be this, definitely going to be that. I'm not an interesting person in that regard. I'm a data and evidence and fact person, and I have no idea. I mean, your guess is as good as mine. What's gonna happen with that? So pass.
Well, Mike, I really sincerely appreciate you joining us today. And to our guests out there, I want you to know that we do have another webinar coming up. And please go to Mike's website. It's mikedp.com. And our next webinar, it will be on Thursday, September 24th. And the wonderful Dave Howe and the incredible, everybody's favorite, Melissa Baki will be hosting that. And thank you all for joining us. We sincerely appreciate it. And if you have any needs for your real estate brokerage, please feel free to contact CREB. Mike, again, thank you. You are a rock star. I'm a follower. And for the record, I did order your book.
Oh, great.
So thanks, guys.
Thanks,
have a
Steve.
great day.
Thanks, everyone. Appreciate
All right,
it. Take care, everyone.